yeah. One more time, we're gonna celebrate. Oh yeah, alright, don't stop the dancing. One more time, we're gonna celebrate. Oh yeah, alright, don't stop the dancing. One more time, we're gonna celebrate. Oh yeah, one more time. I'm just feeling celebration tonight. Celebrate, don't wait too late. No, we don't stop. You can't stop. We're gonna celebrate one more time. One more time. One more time. A celebration. You know we're gonna do it right.
Good morning, everyone. Thank you for joining us for our first quarterly update webinar for Cut Through Venture. My name is Chris Gillings and I'm the founder of Cut Through Venture. And I'm delighted to be joined today by 4 amazing panelists, 3 VCs and 1 banker to talk about everything that went down in Q1, but also look forward and talk through what might occur in 2022. Before we welcome the VCs to the stage, I'm going to take us through a couple of slides very quickly, which just sort of encapsulate the for Q1. So first of all, Q1 was a record quarter for funding. $3.6 billion of capital flowed to Australian startups. What wasn't a record was the number of deals closed. So 169 deals, down from a peak of 227 last quarter. What I will say is that both those numbers will go up. There's always a lag in terms of the reporting that comes through. When we did the State of Australian Startup Funding Report last year, 20% of funded deals came through to us well after the quarter. So we drew a line in the sand shortly after the quarter ended. So you'll see both those numbers go up. But the headline is that total funding was a record, but deals were a little bit down on last quarter. You can see here, Q1 was big relative to the historical records as well, higher than 2020, much higher than the 2 years before that. Interestingly too, in terms of total capital raised in the first quarter of 2022 is just about equal of where we were halfway through last year. This is super important for the discussion we're having today, which is average deal size. So everyone asks me for valuation data. Unfortunately, valuation data is not readily available. It's generally the case that companies really don't like to start disclose their valuations until they start to move into that unicorn territory where it's something to brag about. So valuation data at the earlier stages is pretty rare. And so if you use average deal size as a proxy for that, on the basis that in any given round, the startup's generally giving up the same amount of equity, not a perfect science at all, but it is a reasonable proxy. So if you see average deal size going in a given round at a given round category, it's a fair assumption that that's a signal that valuations are rising, and the reverse is true if you see average deal size tracing down. So you can see here at all stages, average deal size in Q1 was much higher than it was in 2021. And for those that read our report, the State of Australian Startup Funding, you'll know that 2021 saw a massive leap on 2020. The biggest rise was in seed. I think we'll probably talk about that today. but you saw across the board a rise in average deals. Now, in terms of sectors, probably no surprises here. The top sectors were fintech and enterprise software. The movers, I guess, were really blockchain, climate tech, and ed tech, which is super exciting. They're some of the sectors that the VCs had highlighted in our survey last year as what they were most excited about in 2022. So probably not surprising that those are some of the hottest sectors, also some of the hottest sectors globally. And finally, deal participation by female founders. So to be very clear, what we're showing here is the percentage of deals that female founders, either part of a mixed gender team or purely female founding team, the percentage of deals they've participated in. This is not the percentage of dollars. We've made the decision that on an ongoing basis, we're going to publish the deal number as opposed to the dollar number. The reason for that is that the dollar number swings around a lot. If you have a mega deal in a given month, so a $600 million deal, for instance, in January, if that had a female founder, or if it didn't have a female founder, then the numbers are completely skewed. So whilst the important thing at the end of the day is how many dollars are flowing to startups led by female founders, I think a better measure of the change or the trend is actually the deal figure. I'm not saying that either is right or wrong. I think just for our purposes of tracking, the deal figure is actually a better number to look at. So you can see here, overall mixed gender teams, it's essentially flat. There's been really no change on 2021. There has been a good increase on purely female founding. However, it is a very small data set. So yeah, out of 169, there were 17 female founded startups that raise capital. You'll see on the right-hand side, it varies a lot from stage. So you can see angel crowdfunding and pre-deals showed the highest participation by female founders and followed by seed and accelerators and then a little lower on the Series A. Again, small numbers, particularly on the Series A and above, but generally speaking, in all categories except for Series A and above, 2021 is trending slightly better. So that is it for the data. But before we bring in our VCs, I do want to thank our supporting partner, Fresh Equities. For those of you that don't know, Fresh connects ASX companies with their existing and potential shareholders to provide fairer capital opportunities for both investors and companies. In recent times, Fresh has helped companies unlock hidden capital through their smart SPP modeling service, and investors have enjoyed access to unique data-driven market reports, fairer access to capital raises, and have been able to connect in person via Fresh Connect and the Fresh Equities platform. For more information about Fresh, chat to Ben, Alex, Kev, or any one of the 30-person team via freshequities.com. So thank you very much, Fresh, for your support. We really appreciate it. Okay, so now, without further ado, please welcome to the virtual stage our VC panelists, Nicole Small, the Investment Director at Rampersand, Samar Mcheileh, the co-CEO of Scale Investments, and Sam Wong, a partner at Blackbird Ventures. I don't want to waste any time, so Nicole, please kick us off with an introduction on yourself and Rampersand.
Welcome, everyone. Thanks, Chris, for inviting me here. My name's Nicole Small. I'm the Investment Director at Rampersand. We are an early stage technology venture fund in Australia. We back ambitious and visionary founders building solutions for problems across the globe. We are a seed stage investor, so we like to invest early and follow on when we can. And our thesis is pretty generalist. So as long as it's technology based, we are interested to hear and see from founders. A bit about myself is I have been in venture for 4 years now. Previously worked in strategy at Seek, where I worked across product strategy and corporate strategy businesses. And prior to that, spent a short period in investment banking.
And Samar?
Hi everyone, thanks for having me, Chris. Samar Mcheileh, the co-CEO at Scale Investors. Our investment thesis is pretty simple. We invest in women-led and co-led startups across Australia. We're fairly generalist as well. We invest at the pre-seed and seed stage. We have a vision where gender doesn't limit access to capital, and that's gender lens investing is what we're all about, and we believe that, you know, everyone should be looking at that. We invest at pre-seed and seed. We've made 36 investments and 4 in the last quarter. So kind of in line with all the statistics that you're kind of showing us. I think, you know, what makes us really quite unique is we have 70% of our investor syndicate that are women investors. That's what Scale was kind of, I guess, built for, was to change the biases and make sure that more women investors are making decisions. So it's great to see and be on a panel with the decision makers that we're surrounded with today.
Awesome, and we'll definitely talk about some of those gender dynamics a little later. But Sam, do you want to finish off the introductions?
Sure. I'm Sam Wong. I'm a partner at Blackbird Ventures. I'm based in Auckland. I was originally based in the Sydney office and the first employee at Blackbird some 8 years ago. Blackbird is a multi-stage generalist venture fund. So our sweet spot is to start right at the beginning, pre-revenue, even pre-product, like we did with Canva, and then to follow on in every round, even into the pre-IPO or potentially IPO markets. So love early stage, no check too small, but can also follow on with a 700 mil growth fund. We're on our 5th series of funds right now. We've been around as a firm since 2012, and we focus very much on Australia plus New Zealand with a dedicated office and a dedicated team in New Zealand. Probably about 70% of our investing is in software, but also about 30% is in deep tech. And within deep tech, we do everything from space and robotics through to healthcare, clean tech, alternative proteins, and can't wait to find out what we do next with the next fund. And I guess the unifying thing is we're looking for a really enormous scale of ambition, people who want to build iconic companies on a global basis, and originality of idea and approach. Myself, I'm a reformed lawyer, then product manager, then startup founder, and really just got apprenticed into venture as the first kind of, chief of staffy type of role at Blackbird 8 years ago. And that's a bit about me.
Fantastic. So we're in very safe hands. All right, let's get started with the question on everyone's lips. What is different in 2022 versus 2021? Looking at the data by itself paints a picture that everything is exactly the same, if not better. You know, it just looks at Q1 record quarter coming off a record quarter in Q4. So Sam, why don't I let you go first on this one? What are some of the changes or the differences in the environment that you're seeing? Perhaps some of the different conversations you're having with your peers, with portfolio companies, with prospective investors?
Yeah, sure. I think one of the hard things is with the data, I think there's always a bit of a lagging factor because you're waiting for something to kind of be reported. So I do think a lot of the stuff that's coming out as your Q1 2022 results are actually Q4 deals that were being closed. I mean, I just sort of mentioned, I just came back from my first really international trip in 2 years. And what I'm hearing from US and global investors there is definitely more tentativeness in the market at all stages. And it's the pace is a little slower, a little less frenzied. VCs are trying to talk to each other to make sure no one gets ahead of themselves on pricing, lest the multiple contraction, that is happening on the public markets continues rather than halts. No one wants to be left 18 months from now pricing something way out of step with where the rest of the market is at. I would say Q4 last year, no one had time for that. No one had any incentive to kind of to be as collaborative as that with other VCs. I would say I am not yet seeing that trickle down into the Australian, particularly early stage deal dynamic. Maybe that'll happen, next quarter. But I don't want to paint like a bleak picture either, because there is a ton of dry powder out there. It's not that people have closed their wallets or anything of that nature. It's more just like a slight pullback from what was an absolutely frenetic kind of energy at the end of last year.
Absolutely. And speaking of dry powder, Nicole, Rampersand just announced, or very recently announced, a new fund. And so in that context, are you seeing similar things as Sam, and fully acknowledge, Sam, that the cut-through data is a little lagged, but we can also dig into some of that as well. But yeah, Nicole, I'd love to get your insight.
I think, as Sam said, there is a lag in the data. Probably in the last month, seen a little bit more caution around the early stage. There's definitely more talk around what is the impact on public market and the broader macroeconomic trends. What is the impact going to be on early stage startup? So that is a question on our founders' minds, on our investors' minds, and on our minds as well. And so we are having conversations across our portfolio with our investors and with other VCs and peers. I think what we're seeing is at the end of last year, our advice to founders was, if you can, raise now, because who knows what the future holds, and the market is hot and there's a lot of capital out there. I think now there's a lot more caution, particularly for our portfolio companies that aren't raising seed rounds, but more Series B, Series C, around what prices they will get, what access to capital is available. On the side of that, I think there's so much dry powder across Australia, across the US, across the globe, and it needs a home. So I think there'll be a bit of uncertainty, but I do think venture, there may not be as hot prices and fast deal making as last year, but good deals will still be highly contested and really get done. It's probably some more of the mediocre deals or companies that may not get funded or get funded at the level that they would have been last year, is my view.
Absolutely. And Samar, from a pre-seed perspective or some of the earlier stage companies, are they still conversations you're having in terms of the trickle down all the way down to the earlier stages of company formation?
Yeah, I mean, I guess at the super early stage, these women would know as well, but it's really about the founder and who you're investing in, because most of the time there's not a product, or the product certainly won't end up being what it kind of is today, or what the founder thinks it may be. So I think, definitely, I think with any, the global pandemic was the same. We saw the same. Everyone was, really nervous, and people, when they're nervous, the only thing that we can say is when people are nervous, they tend to do and invest in what they know and who they know. So I guess what we're really trying to do at scale, and I think what I'm seeing is probably the biggest shift, is there are so many education programs out there for women founders in particular. At the early stage, there's one for the Creative Co-op, which we're supporting, called Anyone Can, who is being run by Priyanka for women of colour. So I think, really bringing in, there's a lot of work happening even pre-seed to really start bringing the next generation of founders through. And I think you're starting to see it already play out with, some of the really even seed stage funding that has happened in the market, where it's going to all men teams because they've worked at, the Canvas and the Atlassians, and people know them, so they're backing them 100%. So I think that's probably the only thing that I think potentially may continue to occur, is that we need to try and find more pre-seed and seed opportunities where we wouldn't ordinarily look, but there are some great opportunities out there.
So before we change topics, we're going to take advantage of the fact that we actually have a banker on the panel today. Alexnikov from JP Morgan is here. So welcome, Alex. Thank you for joining us. Always great to get a diverse perspective from all angles. So we're really pleased to have you here. Before we kick off, though, we'd love to get an introduction to yourself and the organisation you work for.
Great, thanks, Chris, and great to be part of the panel alongside such great VCs in the ecosystem. So, look, I work here in Sydney as part of JP Morgan's local investment banking team, and I've got specific sector focus on the technology sector. So, I think most people would be familiar as JP Morgan is the largest US bank. We're well connected across every part of the ecosystem in the US, and I've recently joined the platform here in Australia to build out connections and opportunities across ANZ and Asia Pacific.
Awesome. Well, we're in good hands then. So we'll kick things off. Look, the not even an elephant in the room. The obvious thing is that tech stocks have taken a hit over the last few months. It's been pretty wild out there. So just to kick things off, how has that turbulence and I guess underperformance impacted investor appetite for the sector?
Yeah, look, it's certainly been a remarkable few months, really since the third quarter of last year, and then into January and February it's been super volatile, and you know, a large part of the tech sector is now in sort of bear or correction territory. You know, I think what's interesting is we seem to have found a bit of a bottom around end of February and into March, somewhat coincided with the heightened volatility we saw with the tragic events that are unfolding in Europe. But, you know, really what was driving the sell-off in the broad sense was, you know, heightened fears around the interest rate environment going forward. You know, I think a couple of observations from my end is that, you know, valuation multiples have certainly been compressed across the sector, and it's really been those ultra high growth stocks that have hardest hit. You know, they were also the biggest beneficiaries over the course of 2021, so we're just seeing a bit of a correction to their valuations into this calendar year. And certainly, you know, we still see that revenue growth is the biggest driver of valuations overall, but you know, there's a bit of a re-rating as, you know, investors are having to adjust not only the discount rates in their valuation models, but also their revenue and cash flow forecasts as they, you know, try to guess what management's decision making is going to be going forward, and whether they might, you know, try to reduce or manage their cash burn, particularly those that are, you know, more unprofitable. So look, you know, there's obviously some key risks remaining this year, you know, both in terms of the geopolitical environment in Europe, but also, you know, interest rate and inflation risks. But, you know, my view, and certainly the view of the firm as a whole, is that, you know, the pendulum will ultimately swing back, and investors will be willing to take on more risk, and, you know, we'll certainly be back into a very strong environment for the tech sector as a whole. And look, you know, finally, you know, with valuations, you know, now back in line, or in some cases below longer term averages, we're seeing investors to, you know, focus again on fundamentals. And, you know, I think that's what's seeing strong support in some of the stocks, both here locally and in the US.
Fantastic. And so as we extrapolate that out into private markets, so equity capital markets and M&A activity in Q1, you probably read Cut Through Venture. I know you're a big fan. Last week you saw that the you know, it was a record quarter for venture. There's a lag for sure, but from your perspective, what are you seeing from a volume and activity perspective in M&A and ECM? Yeah,
look, I think I'd probably echo the same sentiment that it's certainly a bit of a lag. So while we're seeing a bit of a slower and more cautious start to the year, it's still, you know, we're still in a very hot run. So, you know, globally, tech M&A is very strong, and both strategic and financial bidders are taking advantage of some of the weaker share prices to make really big acquisitions. You know, you probably saw in the US in January, we had Microsoft bid, you know, $68 billion US for Activision to expand into gaming. You know, more recently, there were two private equity bids in the, you know, 10 billion plus US range for a couple of software names that are listed in the US, one being Vista, you know, bidding for Citrix Systems, and Thoma Bravo bidding for a software player called Anaplan. So, you know, people are really moving aggressively, and they're still, you know, very optimistic about the long-term prospects for M&A. You know, locally in Australia, we've had a number of deals announced. You know, particularly recently, we saw, you know, Domain buying a software player called Realbase, and Singtel expanding into Australia with a few acquisitions of IT services players locally. So, you know, M&A as a whole is continuing to be really strong. I think people are a little bit more cautious in weighing up what's happening in the markets, but they're still, you know, moving quite aggressively. I think in contrast, ECM and IPO activity has really stalled. So since, you know, so the middle of January, we saw a real drop-off in activity, both locally and in the US. You know, to give you some perspective, there's only been one US tech IPO of note this year, and that's versus around 50 in the prior 6 months. And so, you know, I think what's happening is people are building their IPO pipeline. They're, you know, really delaying launch until they get more visibility, and then until investors can actually price some of the uncertainty that's in the market. So, you know, from an issuer's and a company's perspective, people are still doing the work. They're still, you know, getting prepared to launch, but they are just being a little bit more cautious on when they, you know, file for IPO, or when they, you know, launch an M&A process. For sure, and that very much resonates or is in line with what the VCs had mentioned earlier. So final question, look, it's the multi-billion dollar question that a lot of folks tuned in for today. I think, you know, JP Morgan, a lot of people probably don't think about it, but, you know, you guys are advising, and the other investment banks are advising the later stage startups as they go through these, you know, unicorn making
transactions where they're, you know, raising hundreds of millions of dollars. So the question is for you, you know, how will this public market sell-off influence private market valuations?
Yeah, look, it is a really good question, and one that we are dealing with, you know, day to day, both in transactions that we have ongoing and in dialogue with prospective clients. You know, I think it's really hard to triangulate, but you know, we certainly are seeing some pressure currently on later stage deals and their valuations in particular. You know, I think our perspective is that it will take a good, you know, 1 to 2 quarters, as you say, for public valuations to sort of seep through into the private market valuations, and that's really due to the fact that, you know, a lot of the recently announced deals, they probably priced, you know, towards the end of last year, and you know, had all the investor commitments, you know, more or less lined up in early January. You know, I think what really matters is the investor community that you're going out to. So typical venture capital, growth equity names are still applying the same discipline and rigor in assessing these late stage funding rounds. But it's really these crossover investors, so hedge funds, pre-IPO investors that are maybe looking at the IPO angle in particular, who are saying, well, you know, why am I buying this private company at a 10x multiple when, you know, public peers are now trading at 5x? And so I can deploy my capital into the public markets as opposed to private valuations. And so it's that type of dynamic that we're starting to see play out, particularly in the US. You know, I think for earlier stage rounds, you know, it's certainly more in the ballpark of my peers on the panel, but, you know, public market valuations seem to be less relevant, just given the nature of the companies that you're investing in and their stage in the life cycle. And so, you know, our view is that, and this is regardless of the life cycle of the company, but the best and most sought after startups are really just as attractive now as they were 6 or 12 months ago. And, you know, the sheer amount of capital that's now competing for these deals, both, you know, domestic money and international funds that are starting to enter into ANZ, it really means that, you know, there's really strong support for the best startups.
Awesome. Well, thank you so much, Alex. Really appreciate your time today, and look forward to you joining us on a future panel as well.
Awesome. Thanks so much, Chris, for having me, and it's been great to be part of the panel. Look forward to speaking to everyone soon.
All righty. Welcome back, VCs. So it is clearly a different environment. There are some challenges, there are some headwinds, but it's not necessarily fully clear what's going on. Sam, I know that Blackbird plays all the way up and down the spectrum in terms of seed stage or before seed stage, all the way up pre-IPO. Last year in particular, and then in Q1 as well, we saw huge growth in seed, both in terms of the number of deals that got done, but also the average deal size. Can you provide any commentary on that, or what you're saying from Blackbird's perspective?
Sure, and I think it ties into what Nicole was mentioning around if you can raise, because the capital is around. So I definitely think there are founders who are either bringing forward a raise or raising more than they might otherwise, because they know the capital is available now and nobody knows if the capital will be around 6 months from now. So I think that has definitely contributed to, you know, almost doubling of seed rounds in the last year. I think the other factor that we're now seeing, which is I think a COVID thing, is that there used to be a bit of a wage arbitrage where $1 would get you much further in Australia or New Zealand for lower wages. But I think we're now seeing that people can work anywhere. The gap between a Silicon Valley engineering salary and a Sydney startup salary is not necessarily a universe different. And so companies are essentially needing to raise closer to a US-sized seed round in order to get the same amount of work done that they did last year.
Right. And on that, do you think, obviously hard to quantify, but what percentage, you know, how many founders were actually thinking that far in advance that they, you know, have really raised enough capital to see them out potentially a turbulent year and not have to go back to the market, you know, for maybe another 8 months?
I think the thing that is like provoking the thinking is like feeling friction in the labor marketplace and realizing, oh, that offer of a salary is not competitive anymore. I need to upsize my budget that I had forecasted for the next X while, and then realizing actually this is going to fall short. I need to raise actually more capital to give myself the best opportunity to hit the milestones to unlock, the next round of funding, whether it's a seed extension or a Series A, what have you.
Makes sense.
We saw that across our portfolio last year. A couple of new seed investments. The rounds were oversubscribed to what their initial target was, and they then came back. The founders then came back and said, actually, pressure, particularly around wage increases, means we want to take on more money. We're happy to have that dilution. We know that money is not going to last as long as it would have a couple of years ago, or even sort of, a couple of months ago. So founders were taking on bigger seed rounds if it was available. But I think it sort of raises an interesting dynamic in this market where there's potentially sort of downward pressure on some valuations, yet the cost of doing business across wages, but across the whole spectrum, is increasing. And so that is going to be an interesting play to see how founders can manage either taking on a greater dilution or having to run a much more tight, efficient business. I listened to a podcast by Jason Calacanis and Jason Sachs, and they said in a sort of boom market, it's all three things you worry about is growth, growth, growth. In a downturn, in a low market, the things you have to worry about is growth, burn, and margins. So it's going to weed out, I think, some startups that aren't running as efficiently as they need to.
Okay, so shifting gears a little bit, not completely because it's all about change, but obviously COVID forced investors to actually change their behaviors and change a lot of your processes. Obviously, we're still sitting here on a webinar. Hopefully by the half, we'll be doing this in person. I guess my question is, how much as the world starts to reopen, Sam, I know you just came back from an international trip, but as sort of just society opens more broadly, are you starting to see any old behaviors come back? Are there certain behaviors or processes that you think are here to stay? Just a question around the post-COVID landscape and what that means for investors specifically.
I don't have hard data for this yet, so this is conjecture really, but I think things like flying or traveling for in-person board meetings, I don't think that they're, coming back as a regular thing. I think maybe it'll be twice a year that it makes sense to do that. But I think, for a lot of people, Zoom is very convenient. I am increasingly seeing US colleagues. Sorry, I'm just going to tell a few people to, can you hear that laughter?
Yeah, all good. Samar, why don't you jump in
Sure.
while Sam deals with the naughty Blackbird people in the background?
Well, she's back in the office, so I think that's clearly a telltale sign of things that are changing.
Yeah.
But yeah, I have to agree. I think one thing that's here to stay is you do not have to meet. Well, our syndicate of investors is certainly still keen, and I think this is happening across the board. You don't have to meet a founder in real life. You don't have to make them come in for a half an hour meeting to pitch to a syndicate of investors. We can still do deals online, and I think that's, particularly for women founders who are usually, bearing the brunt of family responsibilities, and investors likewise. That's awfully convenient, and I think it's here to stay, and I think it should stay. But I absolutely think that everybody wants an in-person experience, and community is probably more important than it ever has been, and finding a unique way to bring investors and founders together for us, where it's a really great learning experience. That's something completely different to what has happened in the past. Like, people aren't just going to come in for a networking event. Like, I think you've got to be really creative about how you build communities, and that's a really great, and I think great opportunity and exciting one.
Sorry,
Sam, do you want to continue your thought?
I'll finish my thought. Apologies. I think people are really keen to reconnect in person. What I'm hearing from US sort of Sand Hill Road colleagues is that their calendars are increasingly being filled up with in-person meetings with founders now that it's possible, and people are keen actually to have that level of connection. What that makes me think is that just leaves less time for Zoom meetings, which I think I think that sort of it ends up being detrimental to folks like, you know, us in Australia and New Zealand, where we're further away, we're not in their backyard. So we either have to get back on planes and go to them, or you know, just find a way of staying very much on their radar. Otherwise, you know, the path of least resistance is absolutely for them to be investing in their own backyard. And I'll qualify that with there are folks who are taking active strategies, you know, not to follow that path. But I'm sensing that very much from the classic Sandhill Road firms.
For sure. Nicole, any thoughts?
Yeah, I think, look, I think there's, at the moment, we're sort of living in a bit of a hybrid world where, you know, there's Zoom and there's in person, and there's probably a preference where you can to meet in person because everyone's sick of staring at a screen. And I know I am. I'm based in Melbourne. A lot of the venture activities based up in Sydney. I just attended a conference, the South Start conference, which was so lovely to connect with such a broad range of people that had been catching up with over Zoom, and there's nothing that replaces it face to face. So I think there potentially will be a sort of a swing to a preference to in person over the next, hopefully, couple of months as people come out of COVID and get sick of just being on Zoom. But maybe it will sort of start to swing a little bit back, and there'll be still a nice balance between Zoom and in person. And so hopefully that's where we'll end up, that it's okay to, it's still acceptable to run a process, invest in a company over Zoom if that's the most convenient way to get the deal done. But I don't think anything ever will replace that in-person meeting people.
For sure. And I apologize, I'm dialing in from New York. If there is a slight delay on mine, it's peak hour here when Netflix gets turned on. So the broadband starts to fail a little bit. I just had a little bit of delay, but I could hear you okay. Hopefully you guys can hear me. Sam, you make a really good point. The international invasion, I guess, that we saw last year of the big funds coming over to Australia and being very, very active. We saw Insight, we saw Tiger, we saw Excel, every you know, you name it, they were there. And even some of the smaller funds, Hustle Fund, I believe, made a co-investment with you guys at Rampersand. Do you think, well, Sam, you were just with a whole bunch of international VCs. Do you think that this could potentially, this sort of closing down, reopening, could ironically close down a little bit the amount of international sort of visitors that we're getting from an investment standpoint?
Look, I think it's so much about relationships, right? And so some co-investment relationships have now been formed between our firms and global firms. So they're not going to shut down overnight, but it is kind of incumbent on us to kind of stay on their radar and refer through deals and keep them connected to our ecosystems. And you know, but so I don't think it'll shut down, but I think it's always your biggest barrier as a founder is you're fighting the space in the calendar of a GP. And so if that time and space in their calendar has been taken up by more in-person events in their own backyard or more in-person board meetings and having to travel, if that happens again, you know, traveling for board meetings, that just leaves less time to meet people who are effective strangers or near strangers or, you know, what have you. And so it's just, we just have to do the work to stay on that radar. But I think on the positive sense, like we've been validated as an ecosystem now. And that's the kind of really positive thing that happened in the last couple of years.
Absolutely. Okay, so pivoting again and looking forward and I guess what's coming down the pipe. You know, fintech, enterprise software was still, you know, huge segment of funding for Q1, maybe Q4, but we have started to now see sectors like blockchain, crypto, Web3, climate, a whole bunch of, you know, little pockets of activity sprouting up. So my first question is, those are the sectors that seem to be getting funded. Have you started to see a different makeup of the businesses that are actually applying? So you're actually seeing different a different makeup of companies popping into the top of the funnel?
I think there's potentially not too much of a difference if you're looking at the pure data. We've always seen crypto Web3 companies applying for funding, health tech companies applying for funding, climate tech. I think the change that I'm noticing is the quality of the businesses and the quality of the founders. So a couple of years ago, with sort of crypto blockchain, it was often people without the right experience seeing some new technology and just applying the blockchain technology to any problem that wasn't really needed to be solved through the blockchain. Whereas now I think we're seeing companies and founders actually solving real problems or the right problems with that technology. Climate tech, I think a lot of the technology, a lot of the business models have been proven out a little bit more, and there's definitely also the appetite on the demand side, so from the customer's point of view as well. So it seems like they're more likely to be valid business models and valid problems to solve with experienced founders.
Right.
So that's what I'm noticing.
Absolutely. No, that makes a lot of sense. The quality, yeah.
Sorry, Chris, I was just going to wholeheartedly agree with Nicole's comment.
Yeah. And Samar, how about yourself?
Yeah, I mean, we're also seeing the likes of Femtech come through. I think you guys would have seen an article in the AFR about Baymatov. So that's a really exciting, revolutionary tech that's coming through. There's also a lot of tech coming through for, specific other women's health related tech, which I think is really exciting. Women's pain is one that is now being recognised, and there's some really fantastic founders that are coming through with some, great opportunities. I think that we're seeing come through, which we haven't seen in the past.
That's great.
And
I guess
is less around the sectors. Like I think Australia and New Zealand are producing amazing companies pretty much across every sector and stage that you can imagine. But I think maybe one thing that's become very noticeable in the last couple of quarters is, some of the unicorn companies are starting to, like, the velocity of companies that are alumni of those unicorn companies, that is definitely increasing. And that's a feature of mature startup ecosystems, right? The next generation of companies are founded by operators or early employees or executives of the companies that came before them. And some of these companies are quite gender diverse internally, and so that's a positive for the kind of diversity of founders that are getting funded or getting started today, and hopefully we'll continue to see that accelerate over the coming years.
And a question, sort of an inside baseball question, I guess, is which of the mafias is it? Is it the Atlassian mafia, the Canva mafia? Who's the most active? Who are you seeing the most? We don't see a lot of. I don't typically see a lot of sort of Canva babies type businesses. Maybe I'm just missing them, but you're seeing a lot of sort of mini Atlassian type products pop up. And do any sort of views on like which of the mafias are the most active and out there and building businesses?
I'm sort of probably not going to name names here, but
Yeah.
I don't think it's just one company, and it is like maturity of the company related. So
Yeah.
like typically, like the further along they are, the more vested their equity already is, and they've de-risked their lives a bit, and that's, I think, the factor. And why you see so many baby Atlassians is just because they're probably they've got 10 years ahead of probably the next oldest startup.
So unless you have any other thoughts around sectors and trends, I think it would make sense to spend a little bit of time talking about diversity. This is I'm very pleased that we're able to have a diverse panel here today. However, as you are all aware, the female funding has sort of stayed steady. It hasn't really sort of moved around. When you look at the participation of female founders in deals, last year it was roughly in line with what it was the year before. and in Q1 it was roughly in line with what it was last year. Female founders only led startup is obviously a fraction of that figure as well, and again, marginally better than what we're seeing in the US and globally, but not exceptional by any measure. So pulling away from the data altogether, I guess the big question is, do you think that the ecosystem is doing enough to address the issue of gender diversity and the gender equity gap?
So I might pipe in.
Go for
I
it.
think I think there's a lot that's happening. I mean, I think I mentioned this right at the start, being on a panel with all women and from diverse backgrounds as well is, you would just not have seen this, I think, a few years ago. And even definitely a few years ago, like not like 10 years ago, we're talking like it's fairly recent that you're really starting to see VCs put female partners, in there. I mean, obviously Blackbird were quite ahead of the pack, putting Sam as one of the first, employees 8 years ago. But that's, I think, definitely a shift that you've seen, or that we've certainly seen. There's so many programs. I think I mentioned this earlier. Education is really key. I think there was a really great blog from SquarePeg about, the lack of the dismal, I think, female founder kind of landscape. And they also talked about what VCs could do differently. So I think I mentioned this earlier, like it's not just putting women in a position to make an investment decision. It's equal, and being representative of society. It's equally changing the way that you process applications, the way that you have conversations, the way that you actually educate women to understand the sector. Like there is, jargon in every sector, and we're absolutely guilty of it. So I think that's a really great thing that we're seeing. And then also the intersectionality piece. We really believe that it's not just going to be, you can't just create like a white women version of the white male VCs. Like it's not going to solve the problem, and it clearly hasn't. And so I think that intersectionality piece is really critical, because you can be a woman and then you add, you're Black, you're Latino, you're pregnant, anything else that you kind of add to that makes it incredibly difficult to get funding and to also just have access. So, we know the two main reasons are accessibility and decision making. So, those things are being tackled in various different ways, and it's really great to see. And I think this morning, I'm not sure if you guys saw the AFR, there was an exclusive. The New South Wales government has just announced, hasn't been quite approved, but hopefully later this year, a $10 million female leaders fund. So following in the footsteps of the Alice Anderson Fund from Launch Vic last year, which has already started to invest. We also announced a partnership with Artesian late last year for a $100 million female leaders VC fund. Cornerstone 45 up to 100 million, 45 million was from Host Plus and Legal Super, which we should be announcing potentially a first investment soon. So it's really, really exciting to see so much money flowing here. I just hope that the trend and the tidal wave kind of continues, and it's not just a trend. It's something that is, gender lens investing is part of how VCs, particularly in Australia, make decisions. And I think, given that the likes of Canva are really coming up the ranks now, there is diversity within those ranks. The Female Leaders Fund created a gender diverse criteria assessment score, which is one that they're hoping a lot of venture funds will, co-invest and implement within their own funds as well. So it just really becomes, Scale will become a, gender lens investing diverse house, rather than it being a female focused, a women's focused house, because that really, I think, is the ultimate litmus test. We know that the research is there to prove that those companies, I mean, Canva is top 10 in the world. So it's testament to, we've had some fantastic exits ourselves as well, and we have women becoming the next generation of funders, which I think is, not only founders, but equally funders, which is going to be life-changing. And I think Australia is really uniquely positioned for that, and we can take advantage of that. And it's great to see the government backing it as well.
Yeah, I agree. There's some great programs to support women founders across the ecosystem. Governments are starting to create funds and back it as well. I look more to, I guess, the pipeline problem and where do founders come from? They often come from a strong operator experience in startups or other large businesses from a STEM background. And we know that there is a problem with the number of women studying and then working in STEM areas. So I think while it's really great, a lot of the initiatives are happening across the ecosystem and the education pathways for both investors and founders, there also needs to be looking at the sort of pipeline problem as well around getting more women into areas of work and then into areas where they get the right experience to become founders. And then sort of the ecosystem has a role to pick up and ensure that we support those women founders. But like another interesting thing was I was on a pitch the other day with two women founders who were exceptionally accomplished, highly ambitious founders with deep insight into the problem they were trying to solve. And it was the first time that I've been pitched to say, we have young families and our partners are really supportive of what we're doing. I have never been pitched that by a male or anyone else, to say, to come forward with that information. And I think that talks to, again, often that women do take on sort of the majority of sort of the household and sort of child caring responsibilities, and often founders sort of start up in their 30s or 40s where that's actually a big part of your life. I know I have young children and that's a big juggle for me. So also as a sort of society, how do we break down some of those problems and enable women to think they can lean in and become founders, but yet still manage sort of the household and child caring responsibilities too. So it just was an interesting point.
Yeah, I just related to the pipeline aspect of it and the founder background, typically, coming from an operator and a STEM background, that is a long-term investment, short, medium and long-term investment that we will need to be making. But one thing that I think is a really positive trend is the StartMate Women Fellowship over the last couple of years has pumped literally hundreds of women in the last 2 years into startups in operator roles. And those are the women who are both getting the experience by joining high growth startups, but also being immersed in the StartMate community, which is essentially, an index of the whole Australia, New Zealand startup community, so that when they're ready to step out, when they have that spark of inspiration, they are going to know the people who can become their CTO if they're not the technical person themselves, or their CPO, or their angel investor, or their, etc. And it's that level of connectivity that is, I think, really going to move the needle in a big way in terms of like overall proportion of startups with either a mixed gender or all women founded founding team. And given how fast those companies grow, given how many women have gone into these startups in the last couple of years, we should probably be starting to see that bear fruit like 3 to 5 years from now in some like obvious or significant way. So I think that's been an amazing trend. And now whenever I'm kind of really asked to talk about this topic, whether it's at IWD or this kind of thing, like I just really encourage my, male technical, brethren in the room to consider when, how they build out their relationships with women who might have great ideas but don't have the ability to build the actual product. Because often what happens is, it's a high risk thing to start a startup with anybody. You're going to take that risk with someone. Just statistically, women are less likely to have friendships with men. Men are more likely to have friendships with other men, and that is like a societal and a structural disadvantage that disbenefits women, and it certainly was of disbenefit to me when I was a founder. I knew literally one other founder in my whole social circle, and fortunately enough, that founder said, "Hey, you should apply to startup and to StartMate." Sorry. And my trajectory was forever changed for having done that. We just need a lot more women to know a lot more people in general, but also men who will spend time, troubleshooting, sharing ideas, sharing their networks to give them a better chance of success of actually, getting started. Until we get, the STEM participation degrees, etc., at 50-50, like that's, I think, another thing that we can do to move the needle.
Fantastic. Well, thank you all for that. Very thoughtful responses. So to wrap things up, I would love to ask you all to give me one company, one startup, doesn't need to be a portfolio company, that you think is really kicking butt at the moment, but for whatever reason, the audience may not have heard of. So they're not showing up in the AFR or Startup Daily or Cut Through Venture. That's the question. So over to you, Samar.
Okay. I think I'm going to go with a portfolio company. One of our companies called Valuations. And maybe some people have heard of it, but many probably haven't. It's a medtech company, obviously, and it's the world's first and only smart, non-invasive artificial larynx that allows you to speak in a natural voice. And it is, every time we see a video of the progression that they've made, it is an absolute tearjerker and revolutionary and incredible. And Flari, the founder, is, she's exceptional. So I think that one there, I think she's actually looking to raise at the moment. She's got FDA approval, which is fantastic and really hard. And she's on her way for TGA and also in Europe as well. So I think that one for me is probably hands down an incredible company. Changing
Fantastic.
lives.
And Nicole?
So I guess following on from that women-led business, I'm going to mention Mass Dynamics, which is also a portfolio company of ours, founded by Paula, and it enables life sciences to transform complex and quantitative scientific data to knowledge better and faster. So they're able to synthesize complex data that comes out of mass spectrometers or sort of high technical research equipment, minimize the synthesis and the cleaning of the data so that the scientists can actually get down much faster to do the analysis of whatever drug they're looking at or a molecular cell they're looking at. And Paula is just brilliant, a brilliant founder, a brilliant leader, and doing really well. They're also in the process of raising at the moment too. So reach out if you want a connection with Paula.
Great. And Sam, take us home.
Well, there's a lot of Australian companies, so I'll pick a Kiwi one. There's a Kiwi company called VEVE. It's a digital collectibles startup. It only launched its app in January 2021. It was 5-something years in the making. But since then, it's been downloaded 2.5 million times, has 1.3 million registered users, top grossing Google Play app in kind of all the major Western countries. And what is so amazing, I think, about it is, amongst all the sort of NFT craze, etc., like the founder, David, has a true collectibles background. He started with stamps as a young kid, moved into Pokemon cards, and before starting VEVE ran 25 bricks and mortar collectibles stores for the aficionados who love to trade this sort of thing. So he deeply understands collectible behavior. And went around the world for 5 years trying to convince Disney, Marvel, and so on to license their IP to him to build stuff on the blockchain, which you can imagine 5 years ago must have sounded pretty crazy to some of these people. And his persistence and tenacity in actually securing those rights, and now the world is a different place, and seeing that kind of pay off. I guess it's life affirming in the way that those Atlassian stories are, right? Of these tales of bootstrap founders who didn't have, VCs beating down their door and stuff, and so on, and building, what is looking to be like a very iconic company from as unlikely a place as New Zealand. I think is a great kind of is a great story to come out of our ecosystem that is probably not well known enough.
Fantastic. That is truly seeing around corners. So amazing to have kicked that off 5 years ago. Well, thank you all so much. Thank you, Alex, for joining us. Thank you all, audience, for tuning in for this first edition. I will send a follow-up email with links to all of those companies that were just mentioned, with links to the Twitter profiles of our speakers today, and the websites of the various funds as well. Really am grateful for you spending your morning with us, and I look forward to seeing you all soon in the flesh. See you later.
They say an end can be a start. Feels like a barbarian still alive. It's like a bad day that never ends. I feel the chaos around me, a thing I don't try to deny. I better learn to accept that there are things in my life I can't control. They say love is nothing but a sore. I don't even know what love is. Too many tears I've had to fold. Don't you know I'm so tired of it all? I have no terror, these are spells. Finding out the secret words won't tell. Whatever it is, it can be named. There's a part of my world that's fading away. You know I don't want to be clever, to be being or superior. True like ice, true like fire. Now I know that a breeze can burn me away. Now I know there's much more dignity in defeat than a brother's victory. I'm losing my balance on the tightrope. Tell me please, tell me please, tell me please, tell me please. If I ever feel better, remind me to spend some good time with you. You can give me your number. When it's all over, I'll let you know. Hang on to the good days. I can lean on my friends.